Welcome to the 9th Annual Hispanic Heritage Foundation Investors Forum. To those of you who are just joining us, we want to take the opportunity to thank our sponsor, TIAA Institute, for their continued support. Up next, we have the Real Estate and Real Assets panel. Joining the panel, we have real estate and real asset investors that will discuss the current state of investing, their perspective on a variety of sectors, and how the lending environment has impacted their assets. Moderating the panel, we have Ada Arevalo, founding chair of Real and founder and CEO of Impact. Please take it away, Ada.
Thank you. Thank you so much for the introduction, Claudia. Good morning to everyone on the West Coast and afternoon, everyone on the East Coast. So as Claudia mentioned, I'm Ada Arevalo, and I am the CEO of Impact Capital, but also, and more importantly, the founding chair of Real, the Real Estate Association of Latinx Professionals. And we're very excited to have partnered with HHF to launch a panel of outstanding real estate professionals in our market. And I would love for each one of them to introduce themselves in no particular order. We can start with Adriana. Good morning.
Sure, good morning, good afternoon. I'm in New York, and everyone. So my name is Adriana de Alcantara. I'm a partner for Hines, which is a 100% privately owned real estate company. We have over 90 billion of real estate assets under management. We have offices and people in 28 countries, and we have over 3,000 people only focusing commercial real estate. I'm specifically the fund manager for our flagship open-end core plus fund, which is called Hines US Property Partners. And me personally, I have over 20 years of real estate experience. I have pretty global experience in real estate. I did asset management, acquisitions, fund management, both in the US and Europe, all asset classes within the real estate. I have been with Hines now for 2.5 years. Before Hines, I was actually 11 years at TIAA, which then became Nuveen Real Estate, and I'm based in New York, and my entire dedicated fund team is based in New York. And I'm originally from Brazil, but I speak Spanish at home.
That's amazing. Thank you and welcome, Adriana. Marco, good morning. Well, you're in Europe, so I actually don't know what time of day it is out there now, but would love for you to introduce yourself.
Yeah, it's 8:30 here at night. Thank you for having me. I'm calling from Milan, Italy right now, where we're acquiring a new hotel as part of our portfolio. 4th generation family office, well diversified. Happy to be here.
Thank you. Pleasure having you. David Schwartz.
Edward Schwartz.
I'm so sorry.
That's okay. No, it's okay. I figured you meant
Edward. There must be a David out there in the world thinking of me, but in the meantime, Ed, would you please introduce yourself?
Thank you. I'm Edward Schwartz. I'm a principal with ORG Portfolio Management, and we're a real estate consultant. We advise large pension funds, endowments, foundations, family offices on their real asset portfolio, predominantly real estate, but we also dabble into other non real estate assets, including infrastructure, farmland, timberland, and energy related assets. I've had the pleasure to work with Adriana before, and then we are certainly blessed to have what a great panel here today. I did want to mention that I did catch a little bit of the last panel on emerging managers, and I just wanted to make one comment about ORG's philosophy regarding managers and strategy, and that is we really always prefer managers that are backed by entrepreneurs, people that are first generation, whether they be college students or immigrants, has been very successful. And really, it's not necessarily, while it is a good thing and a public good, our philosophy is based on the fact that we think many of these first generation business owners are going to be more successful because they have no choice. They have a certain edge, a certain drive. So we love that. And we have been able to find and help put in business numerous groups that are backed by both Hispanics, women, and other minorities. And it's really in our DNA. We have a strong belief in promoting this type of investment, not just because it's a good, and it is, but because we think that they will over time outperform the bigger, more established institutional groups, many of which people that couldn't get jobs for those firms. So, and one of my, and I apologize for taking so long, but one of my favorite examples is, if everyone has heard of the large REIT Prologis, the large industrial REIT, that was founded, the previous firm who they ended up buying, changing the name, by Hamid Moghadam. Hamid was born in Iran, and he graduated from Stanford Business School in 1980. And if people remember the history, in 1980, there was the Iran hostage crisis. And as smart as Hamid is, and he's probably the smartest person in real estate, or certainly one of them, he could not get a job because he was Iranian. And to me, that is my favorite example of someone who founded a firm on a women of prayer a few years later, and has become, one of the most successful real estate investors of our time. So I just wanted to leave with that story, certainly consistent with our philosophy.
No, thank you. Thank you for sharing that. Carolyn, would you introduce yourself, please?
Yes, of course. Good morning, good afternoon, good evening, depending on where you are. My name is Carolyn Inoa-Monje. I have been with Nuveen Real Estate now for 4 years. I'm a senior director on the portfolio management team for our largest fund, the TIAA Real Estate Account, which is a $30 billion diversified real estate fund. Nuveen is a global asset manager of real estate. We're a top 5 manager by AUM. The fund that I help manage is vast majority focused on US investments, however, but we do have a broad mandate and we invest across the risk spectrum. We are, however, currently focused on the last couple of years. We've been largely focused on industrial, multifamily, self-storage, and a sprinkle of other things. But given the current market volatility, we're certainly being more cautious and selective, but our focus has largely remained the same. I'm really happy to be here and looking forward to some good conversation.
Thank you, Carolyn. You brought up a great point, market volatility, or, the current market environment. So unfortunately, our panelist, Marco, has a hard stop. So I'm gonna pick on him first for his thoughts on where we're in a very interesting market currently with high inflation, high interest rates, and substantial market rate compression. How, especially you having such a large footprint in the European markets, how do you see that as a challenge as you enter the US markets?
I mean, these challenges have always been present in themselves, whether it was the US or Europe and vice versa, right? The EU market tends to trend with the US in terms of inflationary rates. The banking system here is a lot more complicated in comparison to the US. Accounting principles are also more complicated. So really, it's knowing how to navigate that. And that's the objective, right? The objective is to amount enough assets that we can later on list them as a REIT and then sell them and get rid of them if it's a problem.
That's a great strategy. So please remind us, your investments in the US, what are you focused on specifically?
As of the last 10 years, hotels, mostly, anywhere between 400 to 500 room keys. And that seems to be our bread and butter today.
And you mentioned a little bit in your introduction about very specific types of hotels that you're invested in Europe, right? Very palace-like hotels. What brought that interest, that investment interest in hotels to the US?
There's quite a difference between palaces that are reformed into hotel business models. Obviously, in the US, we do not have, castles or palaces of any sort, and it costs way too much money to build anything from ground up. Whereas in Europe, because of the constraints and the economic downturns that they've had, these are now available, and they seem to be very attractive to most tourists, business people, and for events. I mean, our catering to events, weddings, it's probably the most profitable of it all.
Got it. Okay. Well, that's great. Let me ask you one last question before I let you go.
Thank you.
When you talk about how did COVID-19, so recently we went through a global pandemic that really hit hospitality hard.
Yes.
But we've seen a lot of conversations about hospitality coming back in a very healthy manner.
Mm-hmm.
Do you have any concerns, since you're investing in hotels, do you have any concerns, or what's the trend that you're seeing with COVID-19 or the world restrictions as they are?
Post-COVID, today, both countries that were mostly involved in Spain and in Italy today are completely past it. The retention or occupancy rates are probably above 90% in most hotels. There's a huge influx of Americans that were not allowed to come to Europe for a very long time, and now finally they're coming over. So we see a lot of these trends, especially also from the Northern European countries that like to be in the Mediterranean countries for everything that the culture offers, right? Food, fun, and so on. So it's growing and it's expanding, and it's quite the opportunity right now. So during the pandemic, we bought whatever was left behind. And that was a very good strategy. So we always look for crises where we can buy low, very low, and then now we're just in growth mode.
Great. Well, thank you so much, Marco. I know that you're in a very different time zone than all of us, so we appreciate you taking the time to join us. And I'm going to kind of step back on the first conversation, and Adriana, Carolyn, and Ed, let's go back to talking about the current economic environment on interest rates, inflation, and the market rate compression that we're seeing across real estate investments. So a lot of people would like to know, have your investments been affected? If so, how? What are you doing to mitigate those risks? We continue to hear that interest rates will continue on an upward trajectory, at least for the foreseeable future. Inflation might, balance itself out, but how are you mitigating those risks in your investment? And are there any changes to your strategy in order to mitigate those risks? So what are your thoughts, Carolyn?
Sure. So, first, I'd like to acknowledge, yes, you're completely right. We're coming off of a period of unprecedented rent growth and cap rate compression. And for the last couple of years, that's been really great for our performance, both on the income and the appreciation side of the equation. Now, what we expect is that growth is going to slow. I think there's no question about that. But we're confident that we've built a quality portfolio and anticipate that returns, while they will be more modest, they will still be positive. Now, going forward, historically, real estate has been viewed as an inflation hedge due to rent growth. And so far, we've seen that sectors like that we've been largely investing in currently, like multifamily, industrial, self-storage, we've seen rent growth outpacing inflation. Now, if we get to a point where that's no longer the case, we're going to start to see some degradation in value. But that's where the diversification of our fund is very important, because there may be regions or sectors where rent growth moderates more than others, and you hope that there's a smoothing effect there. So that's the existing portfolio, and while we haven't seen much of an impact right now on our values. It's not to say that it won't happen, but right now we're holding steady. Where we're really seeing the impact is on new acquisitions. So of course, leveraged buyers are being squeezed because of the rising interest rates, and we're seeing less competition when bidding on certain deals. We are beginning to see cap rate expansion in, for example, multifamily to the tune of about 50 basis points, and industrial maybe 25 basis points. And since we are largely cash buyers, we can be a little bit more competitive. We can offer certainty of close and hopefully achieve some discounts on those acquisitions, where we're actually being very selective in what we do look at. But the last thing I'll say on that is just, as assets do start to trade at discounts, and if that trend is pervasive and continues, inevitably those comparables are going to start to affect values in our existing portfolio as well. So it's all connected. It's really hard to predict what the full effect is going to be, but we're obviously watching it closely. And as far as mitigating risk, I'm sure we're all probably doing the same thing. We're moderating our rent growth assumptions and our underwriting, increasing our going in cap rate as well as exit cap rates, and just being really, really selective and going for those really high conviction plays. But I'll leave it there for now.
No, that was great. Thank you. Adriana, what are your thoughts on our current economic market?
Right, very interesting, because as I was saying before, Carolyn, she knows it. I was at Nuveen for 11 years, so I know her fund pretty well. Well, anyways, I'm going to start by the last question. So it's changes in strategy, Ada. Not really. We're sticking with our strategy. And I do think that in moments like this, it's important to stick with your strategy, right? And avoid style drift. And in fact, any portfolio in this market, I think everyone is going to be impacted, right? But some people to a lesser extent than others. What we focus to start on a portfolio, we focus on multifamily and industrial. And what we're seeing is that is starting to pay off, and avoiding long-term leases. That was super key to us, avoid bond-like returns. So we have seen tremendous growth in our rents in our multifamily and industrial. And the other point was as well location. We were not ready to go to certain, primarily for industrial, to certain Midwest markets. People chasing for yield. We don't have any assets, industrial assets in the Midwest, Western markets, which I think is going to be more affected. Yeah. So we really have our assets are in high barriers to entry markets. So certainly, once again, there is going to be an impact, but because rents are growing in our portfolio quite, it's significantly, I'm hoping that's going to be a wash. That's what I'm seeing right now. Now, the other point that we have been really very careful is acquiring office and retail. We actually have only one office building in our portfolio. I saw the PRIA consensus this week coming out for returns for the different sectors, and the implied cap rate for office for the broader market, right, in the US. I'm not going to, I know that some people here don't know too much real estate, so I'm going to talk like the broader market, but I'm seeing cap rates for office at 4.7. I don't think that's right. There is more blood to come on the office space, right? And we probably won't see that. It's going to take another 2 quarters to see more of that, I think. So we have been very selective there as well. And in terms of what we're doing to mitigate risks, I think it's back to basics. Location is always important, but so more important than ever. So no compromise of location, cash flow, and asset management. I do like the fact that we have over 3,000 people in the US, so the guys are super, super highly focused on, the penny, the differences in the detail. as Carolyn here, so there are many good people out there. We try to bring the detail to the table with all these people.
You bring up a great point. You know, that what's the number one rule in real estate? Location, location, location. So
Yeah.
you brought up a great point. Thank you for that. And you have a very different point of view because you have the opportunity to talk to a lot of sponsors and a lot of GPs and see a lot of different strategies. How has the current economic market, what are you seeing in terms of changes with these various strategies?
Yeah, it's been a very interesting ride, and we always think differently than most of our peers. And to give you an example, for many years, our clients have dramatically overweighted industrial and apartments. And what we've seen is a huge wave in that area where so much capital is moving in that direction. And with our research team, we looked really long and hard about, boy, do we take some of these gains in industrial and move it to a different area or even apartments. And as Carolyn and Adriana have said, what we've looked at very carefully and felt the answer is no. And the reason is because office, for example, which had been 40% of the index for many years, is finally coming down. We've always had a dramatic underweight to office, and it's just math because it has always underperformed and over periods of time and been the highest risk of the property types. But I'll give you a little anecdotal example. So we looked hard at some industrial. So boy, the industrials run so much, the cap rates are low, in some cases in threes. And for those who aren't familiar with the term cap rate, it's simply the first year unlevered income return on a property. So if you're in the low 3%, that's pretty low. And you're thinking to yourself, well, are there better alternatives? And as we looked at our client portfolios and some of the funds that they're invested in, we realized that the in-place rents are 30 to 50% below the market. The rents have gone up so much. So yes, we're very concerned about interest rates and cap rates moving up, which then will reduce the value similar to a bond.
Yeah.
But because rents are so far below market, and we still see good fundamentals, and with inflation and replacement costs going up, we still think industrial and apartments are good places to invest in overweight. And some of the other issues that we see that I think are more difficult to solve are things like housing affordability. And that to us is a huge issue. And we look for investment strategies that play to that provide good affordable housing. And I'm using the affordable with a small a, not technical.
Regulated.
Yeah,
You're talking about naturally occurring, not regulated. Yeah.
Right. Naturally affordable housing. I mean, we do look at the others too, but that's not what I'm speaking about now. So these are the kind of things that we look at. What's really happening in the world? People not able to afford what they could with energy prices rising. No one's talking about electricity. When we start getting our electric bills, and they'll be 2 to 3 times what they were last year.
Yeah.
The grocery store bills. Something's got to give. So we think a good defensive strategy is one where there's just affordable housing. People can afford to live in certain rental housing. So as interest rates move up, housing affordability to purchase is being challenged. So we would echo the thinking. We're always looking at ways to optimize our clients' portfolios, but we think there's a lot of uncertainty in office. What's going to happen with work from home and companies and their views on office? The cost of building office and retrofitting office is sky high. So and the valuations are seem to us too high. So we don't like that. And there's some retail strategies that we do like, but they're smaller, more niche strategies. One of them being ethnic grocery anchored retail.
Oh yeah, like more community retail, right? As opposed to the big mall.
Yeah. One of our secret strategies that we've been backing is such that a fund focusing on retail that invests in ethnic grocers, mostly Hispanic grocers. And the reason is because they're great tenants, they're great credit, and most of the institutions will not buy a center that isn't anchored by Kroger, Safeway, or Publix. So we think that's a great opportunity. So those are the kind of things that we're looking for as we, advise our clients.
Gotcha. And, I think the market agrees with you. So that's a great point. As we talk about the economic markets, institutional investors especially, there's a lot of conversation about them getting nervous about the market, which always kind of halts capital. But it could also open up the floodgates for more opportunistic, more hedgeful strategies like the ones that you were talking about, Adriana. So in terms of capital flow, and you have an open-ended fund, so you see capital flow all day long. Where is your capital coming from now? Do you hear concern from your investors with respect to the three things that we just talked about in our market?
Oh, yeah, definitely. So, and I would say three things, right? It's an interesting environment because we have a very strong dollar. We have the war in Europe, right? And we have the stock market, what we call the denominator effect. Many funds in the US, many public pension funds, they are over allocated to real estate. So it's an interesting environment right now, starting with the strong dollar. The last 2 years, we had a window where hedging costs went really down. So you were able, although we had the pandemic, so in our case, we were able to raise a significant amount of money from Asia, from Europe, although we have as well, Ed is here, we have quite a lot of money from the US as well. Now, for foreign money right now, hedging costs went really significantly up once again. So they are still interested in the US, and I have quite a lot of meetings with foreign investors coming in the next 2 months, including Asia is opening now for traveling. So that's great. So you name it, Korean investors still, primarily insurance companies, Japanese investors, but they are being careful because of the cost of hedge. But the alternative is to invest in Europe, right? And we do have an open-end core plus fund in Europe as well. We have been successful as well, raising money, just launched that fund. But I have to say, any investor, they go to Europe right now, I mean, all their investment committees, they're going to ask about the war, right? And some are more concerned about the others. So I think the coming months, they are going to be, I would say it's going to slow down in terms of raise, but people still need to invest. Yeah. People still need to invest, and we need without the money that we have raised, we need to deploy as well the money. So we're being careful deploying, when you say, where do we put the money? Being careful deploying the capital. As a matter of fact, well, Ed is here, one of my clients, right? So we have been careful deploying the money. We have another 60% to deploy. And I do think we're going to see a more advantageous market in pricing environment.
Yeah. And
I do think as well, investors are seeing this. So it's going to be a very interesting market in the next 6 months.
No, I couldn't agree with you more. And Carolyn, talk to us about where is your capital being deployed to? And for the audience that doesn't know where Nuveen's capital comes from, I think it would be great to talk about where does Nuveen, raise their capital from, and where are you deploying it into at the moment?
Sure. So, as I mentioned, Nuveen is a global real estate asset manager. So our capital sources are very, for our third-party funds are very similar probably to Adriana's capital sources, right? there's been certainly a lot of interest recently from foreign investors, but also US based. That said, my fund is quite different. The TIA real estate account, which is really my area of expertise, is actually a very unique vehicle whereby we manage retiree capital. So these are individual investors. They allocate directly from their 401ks, their retirement accounts to our investment vehicle. And those are modest allocations, but we have millions of investors. And what we've seen across the last several months is actually a continued steady inflow, which, to be honest, is not entirely surprising given the consistency of our returns, especially in comparison to what the public markets have been doing and either their other investment options. So that's where the fund that I help manage specifically, probably differs quite a bit. And then as far as where we are deploying, I have to, again, agree with Adriana in the sense that we're sticking to our guns, we're sticking to our strategy despite the market volatility. So we do still believe there's some run rate in multifamily and in traditional multifamily and industrial. We're just picking our investments, very selectively and very carefully, and being more conservative in our underwriting. And we're not afraid to walk away from a deal nowadays, whereas we would have maybe pushed a little bit harder a couple months ago. Now we're not afraid to walk away from a deal. And then we're looking at some, I mentioned self-storage. Self-storage has been just a rock star for us over the last 5 years. Since actually we started investing in self-storage about 5 years ago, and it has just been a consistent rock star for us. And it continues to be that way. We've seen double-digit returns from self-storage, since we started investing in it. And that was particularly true last year, where self-storage was second only to industrial, but industrial was through the roof, as you all know, in terms of return profile last year. And so we still believe that demand for self-storage is going to be strong. That demand is driven by, a lot of things, dislocation, sadly, deaths, people that are downsizing, even corporates and that are downsizing or shutting down office spaces. They sometimes tend to utilize self-storage to store some of what was in those offices. So it comes from a very varied set of sources, the demand, and it remains strong. The last thing I'll say is touching on actually the affordable housing theme that Ed mentioned. One of the things that we are starting to look into is both manufactured housing and single family rentals. And we believe that there's a little bit more yield to be had in those areas, perhaps, versus traditional multifamily. And particularly, there's an opportunity for potential portfolio aggregation play as well. Mm-hmm. And so we are starting to look in those areas as well. And single family rental and manufactured housing can both be part of that affordable housing solution. Yeah. Of course, if we maintain it as affordable, right? So we also have to be responsible in our management of those assets to not displace tenants. And that's actually one of the reasons why for manufactured housing, we've been looking at development, because where we've seen opportunities in the past with partners that have shown us investment opportunities where you go in on existing assets and the rent growth in the first year or two, is astronomical on these manufactured housing investments. And of course, you're going to displace tenants. you're going to put an enormous strain on them. And so not only is that a risk from an investment standpoint, but it doesn't make you feel great, right? On the other side. So on development, it's a little bit of a different story because you're setting the price point for the development at the onset. You're not displacing a community to increase your rents. And so that's one of the reasons why we're looking at it from that angle.
No, so you touched on two important things. Manufactured housing, one of the things that I've often heard in panels is, why has it taken it so long to, I think the goal when manufactured housing first came out, the goal was that it would either supplement or completely take over the development of real estate. I don't know that it's been successful in, at least at scale, at accomplishing the original goal. And my question has always been, why? There's so many different ways to do manufactured housing. So it's interesting that it just hasn't achieved what it was set out to achieve. But you also mentioned single family rentals. And I want to ask all three of you, if you have heard from your investors a need or a want to stay away from single family rentals. In the impact space, there is a huge push to stay away from single family rentals, mainly because there's diminishing supply of single family homes, especially entry-level homes for first-time buyers. And for an institutional investor that has unlimited capacity to buy them up and absorb the very little inventory. I mean, we see the housing crisis that we have now, forget about multifamily, trying to get into a first-time home is extremely challenging, and it's mainly the inventory. I wonder if any of the investors that you guys work with have mentioned a desire to stay away from single family rentals.
Yeah, we have one particular client, foundation client that makes sure that we pay very, very close attention to any type of gentrification. And if you think about the institutionalization of single family rentals, it has led to some form of gentrification in the sense that these institutions are adding more pressure, bidding up the price of the homes, and many people then can't afford the homes. In addition, when they're in the homes renting, many families rent these homes, in their operations and their pro formas, they're increasing rents, and the rents have gone up a tremendous amount. And there's political pressure and as well to limit not only the ownership but also the rents. So we have seen that as an issue with respect to our clients wanting to be very, very careful and limiting that investment sector.
Have you seen any of your investors have that concern, Adriana?
Yes, yes, we do have some investors that have that concern. I will tell you that Hines, well, we do have a large portfolio, so we have done as a developer and as acquisitions, SFR and BTRs. So we have done that, single family homes. In my specific portfolio, I haven't done it. And I have to say that I do not plan to do it in a foreseeable future. It's still, you were talking about scaling up. It's still a sector that beyond all the issues that you have mentioned in terms of affordability, has a problem of scale as well. Getting scale to it is really very hard. All this, and by the way, we are, as a fund, we are looking at alternatives and all these alternative sectors, and that includes SFRs, but includes as well life science, self-storage. Carolyn was talking about self-storage. Is still a small, really a small part of the broader market. What that means is, number one, as an example, self-storage and life science, there's a lot of competition for the same assets, right? And it's hard to get scale as well. So, but to answer your question directly on the SFR, yes, we're seeing some clients getting a little concerned about SFR. And we, so far for the fund, have not invested and don't see us investing in the foreseeable future.
Gotcha. I'm asking for a little bit. Sorry, go ahead, Carolyn.
Oh, if I can add, on the SFR, yes, I think consistent with Ed and Adriana, you know, certainly when Nuveen Real Estate started investing in SFR, you know, headline risk and concerns from investors were definitely one of the main risks that were discussed. The one thing that I will say is that I don't know if you might have seen in the press, but Nuveen Real Estate recently launched an impact sector that we're hoping to grow, exponentially across the next several years. And I'm not part of that fund, but I can tell you that, you know, in looking at SFR from their vantage point, one of the things that they're trying to do is partner with organizations that will manage the assets responsibly, not displace tenants, and not only that, but help provide tenant services that, you know, like financial literacy and improvement of credit scores and things of that nature.
Yep.
To prepare tenants to eventually be homeowners and potentially even buy the home that they are renting from us. So that's one of the ways that we're looking at it, SFR, not my fund in particular, but still Nuveen Real Estate, the impact sector, doing it in a responsible way that actually makes a positive impact on communities. So there's a way to do it. I mean, there's a way not to do it, of course, but there's a way to do it while still being responsible.
Responsible. Could not agree with you more, and that's a great point. So let's talk about what's the outlook of our market in the long term. I mean, real estate, like Adriana mentioned, as a whole, it's thought of as a hedge to the main financial markets. We know that in general, institutional investors' portfolio invested in real estate is between 6 and 10%. And then you have all of the individual sectors of real estate, a lot of which we talked about: industrial, multifamily, self-storage, office, retail, etc. Where do we think that the biggest opportunities are going to come in the next year? Because it's so hard to predict real estate, right? But in the next year, where will be your biggest opportunities? What do you think, Adriana?
Let me tell you that, as you're saying, long-term is the key, right? I have clients that are multi-asset strategy clients. It makes so much sense to have private real estate in their portfolios for all the reasons that we mentioned already: diversification, inflation hedge. And I do think the open-end format, to me, I'm a little biased, it is true, is the right format to hold real estate. Beyond that, next year or so, it's going to be I think it's going to be a very interesting market. We do have already kind of a pretty good portfolio in terms of inflation hedge, because we have short-term leases, multifamily, industrial, and so forth. So it's capturing inflation well. What we're starting to look right now, it's two things: student housing in really close, top colleges in the US. That's number one. It's a good diversifier within our multifamily portfolio. And the other thing that we're looking as well, we started looking at grocery anchor retail. I did not look at ethnic grocery anchor retail, but you gave me an idea, so I'm going to look at it. But we are. Although let me tell you, there is money. What is happening as well in the market is there is still significant money to invest in real estate.
Yeah,
right.
Great.
So we'll see what happens. Same for Carolyn. We are cash buyers, so I think we have a little advantage, and we are seeing already some pricing dislocation. I do not expect distress in the multifamily industrial. I do expect perhaps some distress in broken developments, office, and this kind of things. But there's still a lot of money for multifamily, industrial, everyone chasing the same, unfortunately. So let's see the next months. But that's student housing and grocery anchored retail. That's my next one.
Love it, love it. Carolyn, what are you gonna be focused on? Where's your portfolio's opportunities coming from in the next, year or so?
I wish I had a super exciting answer, but much like Adriana said at the top of the panel, I think it's important to not to style drift. And so it's the things that I mentioned, it's gonna still be in, industrial, multifamily, a little bit more self-storage where we can get it, because as Adriana mentioned, it is hard to source those deals. And then some alternatives here and there, but I think the key is to be selective. And then as far as geographically, it's about following the growth, right? So the Sun Belt is still going to be a high target for us, but I will say that, that there are tried and true markets, high barrier to entry markets, gateway cities and suburbs of those gateway cities where, we haven't seen that Sun Belt level growth over the last couple of years, but there will be, those are very resilient markets that we think will still do well. So as an example, the Boston suburbs was an area where we recently acquired a multifamily property, and we're very, it was a great investment, and that, we were able to achieve a really great price point. We think it's going to do excellent. The fundamentals are great. The industries around there are resilient. The demographics are strong. And so it's all deal by deal. And we're going to chase the best opportunities. So, that's where I'll leave it.
You just mentioned gateway markets, which reminded me about something super important. So there's been a lot of, ever since the pandemic, right? There's been a lot of intermigration within the country, people leaving kind of urban America, going a lot more suburban. Has that expanded your view of your target demographics? Meaning, is your portfolio now more open to secondary markets and tertiary markets that are seeing a lot more inflow of people coming into them, or is that still considered too risky?
Certainly not. I certainly wouldn't say tertiary markets. I think even pre-COVID, we started to expand south. So, Atlanta, Nashville, Charlotte, Raleigh, Orlando, and those are all areas that have seen tremendous growth and in migration, actually particularly during COVID. So that's been successful for us, but I wouldn't go as far as to say tertiary markets. The other thing too is we have, in a post-COVID world, been very mindful of the suburban trend, the sort of outflow of folks from cities and into suburbs. So we have been more selective in what on multifamily, on what we look at in urban markets, and we have disproportionately purchased in the suburbs. But they're suburbs of those strong urban centers. So we haven't strayed too far, but that's where we've been, searching for opportunity.
Thank you for clarifying that. And I'm going to come back to you because, again, you have a very unique opportunity because of everything that you see.
Yeah.
In the near future, where do you see your clients' focus and placement of capital going?
Yeah, it's very interesting. It's hard to find great themes, as I think Carolyn was alluding to in today's environment. But I will say a few things. I think it's important not to just follow just on a blanket basis what has worked in the recent past. And I'll give you a few examples. So The shift from urban to suburban actually started before the pandemic, and it was largely precipitated by demographics, where the millennials were starting to get married, having kids, and wanting to move out to the suburbs. So certainly the pandemic accelerated a lot of the movement. But one of the things that we're seeing is interesting opportunities in some of the urban markets. New York City apartments. We're exploring the Bay Area apartments, although there's a lot of other issues with that. So, historically, New York City apartments have been very, very expensive relative on a cap rate basis relative to others. Now they're not. Now, in some cases, there's reason for that with some of the legislative changes. But if you factor that in, and there actually has been a tremendous movement back into a place like New York City. So I would caution investors to not just fall in love with the new Southern growth markets, because what's happening in those markets is what attracted people to those markets was the affordability.
That's a good point.
And now, again, this is a theme that we keep hammering on. The affordability in some of these markets is not very good. And you look at South Florida, where there's difficulty with availability, but also the pricing is so high, and Nashville is getting expensive, and Charlotte, these cities that people flock to because of lifestyle and affordability, it's not that way anymore. And so if you think about moving from New York to Charlotte, but your cost is not great and you still have tremendous traffic, we kind of question that as a long-term trend, or is it just temporary? So we look for opportunities like, I love the Boston idea too, but some of these cities that may not have the growth, but they have tremendous barriers to entry. They're priced better on a relative basis probably than they ever have been. So we would suggest, that might be an area focus on housing affordability.
I definitely agree with you, Ed, as well. We bought in Boston and Seattle. I agree. That doesn't mean that we are not going to buy in Austin, which we did buy in Austin, right? But you're seeing rents in Miami in Brickell studio $6,000.
Yeah.
Yeah.
It's crazy. It's crazy.
I don't know. Yeah, it's probably a New Yorker renting it. I get it, but the salaries are still not there, Miami. And I would add the cities, and that includes all this, well, Miami, Austin, but they don't have yet the transportation links.
No.
They don't have the amenities, and they don't have really the talent there. You cannot compare Miami to New York. You cannot compare Miami to Seattle, right? So yes, we're being careful. I mean, that doesn't mean that you have still to look at the Sunbelt markets, but it's going to take at least another 10 years for these markets to consolidate, I think.
I think you both bring up a great point. I mean, Ed, I think you're really challenging us to think about this in terms of once the affordability factor is completely gone, will the appreciation for the secondary market still be there, or would it just be the same as moving back to New York City, where you can walk to work, where you can take the subway, shopping, school, etc. And these submarkets don't have the infrastructure.
Ada, let me tell you one thing. I don't know how people live in New York, because rent for a studio here is as well $6,000. Okay,
right, right. But you're getting New York, but
you're getting a job.
The other thing that I wonder about, you're getting higher pay, but also for those living a little bit outside the city, maybe a longer commute, instead of having to go in 5 days, if you only have to go in 2 or 3, maybe it's easier to have that commute. So I just wouldn't throw out the old cities in the Northeast as uninvestable. I think there may be some really, really good opportunities in those markets that many investors are overlooking. And for us and our clients, that's where we like to find. Don't always go where all the capital is, because then you're competing with everyone else and paying top dollar. But go oftentimes where the capital isn't, and don't make foolish mistakes like maybe a lot of office plays. But there are some really interesting opportunities if you can think just a little bit outside the box.
Mhm.
There will always be reversion to the mean, right?
We think so, yeah. Yes, yes.
So definitely have to think about your investment term as well, and whether you're doing something for
Yep.
a short-term play or more following, you're
Sure.
more long-term thinker. So completely agree.
Well, we have 3 minutes left, and I'm going to thank my panelists because you guys did an amazing job on staying on time, on target. This
Thank
was
you.
an amazing conversation. I think we answered the questions that we got. The last thing that I think I will kind of close out with, and Ed, you started the conversation with this, which was on DEI, right? Looking at probably first-time managers, diverse managers, and this is Hispanic Heritage Foundation. And one of their goals is to elevate minorities. And I want to point out that Carolyn is a senior executive, Adriana is a senior executive and a Latina. Edward, I'm sure you're a super supporter of us. Thank you. I'm a first generation.
More than you know, for sure.
So, we are here. We absolutely had to work hard and prove everything that we do every day. But this is an example of everything that we can accomplish. And real estate is an amazing asset class. And we thank you for joining us. Thank you very much to our panelists. Until next time.